Okay, so imagine you are standing in the middle of a massive, crowded stadium.
Right, like a huge arena.
Exactly.
Yeah.
There are, tens of thousands of people milling about. The atmosphere is humming, and everything feels, well, completely stable.
Safe, yeah. You're just watching the game.
Yeah. But suddenly, someone up in the upper deck yells, "Fire!"
Oh, wow.
Right. Panic ripples through the crowd. But the true terror in this scenario isn't actually about the fire itself.
No, it's the structure.
Yes. The real nightmare begins when you look around and realize that stadium management just locked all the exit doors.
Just chain them shut.
Chained them shut, except for one tiny turnstile at the far end of the concourse.
That is a terrifying thought.
It is. The panic isn't just about the initial spark anymore. It's about the sudden, terrifying lack of a way out.
And, if you are managing a portfolio or running a business or simply trying to understand why the cost of living feels so erratic right now.
Which everyone is.
Exactly. You need to understand that this stadium analogy, it's no longer just a hypothetical scenario.
It's the reality.
It is the exact architecture of the global economy today. I mean, the stadium is the financial market.
Okay. And the fire.
The fire is the constant, everyday drumbeat of geopolitical conflict. And those locked doors, that represents the absolute evaporation of global liquidity.
So we're essentially challenging some massive assumptions today on this deep dive.
Oh, absolutely. The biggest ones.
Because if you look back how most of us were taught to understand global markets, there was this bedrock assumption of stability, right?
You were conditioned to believe that markets moved on relatively solid, predictable foundations.
You looked at economic growth expectations.
You tracked corporate earnings cycles.
Yeah, and you relied on central banks that telegraphed their moves months in advance.
They held your hand.
Exactly. But that entire framework has been pushed entirely into the background.
It's gone. What's replaced it is a highly unstable, highly reflexive system.
It's a vicious loop, really.
Yeah, it is. It's a loop driven by global geopolitics, which is then violently transmitted through energy, inflation, and currency markets.
So today,
Yeah.
for you listening, we are taking you inside what we call the geopolitics liquidity loop.
It's a vital concept.
We are going to break down the mechanics of why you really have to stop thinking about the economy in isolated variables.
And start thinking in chains.
Right. Okay, let's unpack this.
Yeah.
Because the shift in mindset here, it's moving from looking at what is happening to understanding how it spreads.
The old variables, earnings, GDP, consumer confidence, they haven't vanished.
But they aren't driving the car anymore.
No, they are passengers. The
Yeah.
driver is this continuous feedback loop where political friction fundamentally alters the cost of capital globally.
So to understand how this loop functions, we have to start by defining the actual environment it operates in.
Which means acknowledging that we have transitioned, quite forcefully, from a unipolar world system to a multipolar one.
And let's dig into the mechanics of that shift. Because multipolar, it can sound like this academic buzzword.
It does get thrown around a lot.
Yeah. So to understand where we are, let's look at where we came from. Like in the 1990s and 2000s, the unipolar era.
Right, the era of enforced stability.
Exactly. There was a dominant framework for global trade, security, capital flows.
Yeah.
And because that stability was essentially guaranteed, markets just priced it in as a permanent reality.
It was treated as a law of physics.
Right. Corporations optimized their supply chains for maximum efficiency and minimum cost,
Which gave us the just-in-time inventory model.
which we all know now has huge vulnerabilities. But back then, you didn't need to stockpile microchips in a warehouse in Texas.
Or auto parts in Ohio.
Yeah, because you knew, as a mathematical certainty, that a cargo ship from across the world would arrive on a Tuesday at 2 p.m. without any interference.
Because in that environment, the underlying assumption was that economics simply trumped politics.
Money talked.
Right. The belief was the seas would remain open, trade agreements would be honored, and borders would remain porous to commerce.
Because it was in everyone's financial interest to do so.
Exactly. But a multipolar system fundamentally inverts that logic. It is characterized by constant structural friction.
Power is distributed differently now.
It is. Regional hegemonies emerge, and the rules of engagement are continuously tested.
Yeah.
So in this new reality, politics trumps economics.
Meaning nations are actually willing to suffer financial pain to achieve strategic or security goals.
Yes, and the market impact of that is just profound.
Because those geopolitical events, wars, heavy economic sanctions, strategic rivalries, they used to be classified as tail risks, right?
Right, the black swan events,
Right.
rare stuff.
You might buy a little insurance against them, but you didn't base your daily operational model on the assumption that, say, a major European land war would break out.
Or that a critical Middle Eastern shipping lane would be blockaded by drones.
But now those aren't tail risks anymore. They are the baseline.
We are seeing the foundational elements of the global economy actively weaponized. And it extends so far beyond traditional military conflict.
Right. It's not just tanks and troops.
No, we are seeing energy access weaponized through pipelines and export bans,
We're seeing critical maritime trade routes shut down.
forcing ships to route thousands of miles out of their way. Yeah. We are even seeing the global financial plumbing, the clearinghouses, the payment systems used as actual instruments of leverage.
Okay, hold on. Let me put myself in the shoes of a risk manager or, an investor looking at this landscape for a second.
Sure.
If friction is constant and literally everything from a shipping lane in the Red Sea to a semiconductor export policy can be weaponized overnight,
Which they can.
how do you even model for that? I mean, when the baseline itself is unstable, doesn't the market just enter this permanent state of pricing in the absolute worst case scenario?
Well, the market tries to, which is exactly why volatility spikes so violently.
Yeah.
But it can't actually sustain a permanent worst-case pricing model.
Why not?
Because when a geopolitical headline breaks, risk is pulled forward immediately. Let's look at the mechanics of how that happens in real time.
Okay, yeah. Walk me through it.
If a conflict threatens a shipping lane, the cost of maritime insurance for a cargo vessel, it doesn't just gradually increase over a month.
No, it quadruples overnight.
Exactly. The shipping company immediately decides to reroute around a whole continent, adding 2 weeks and $1 million in fuel costs to a single voyage.
So the risk is priced in instantly. Uncertainty becomes the main input.
Yes. But if we connect this to the bigger picture, geopolitics alone, purely as a headline, it can't fundamentally alter the global economy over a sustained period.
Right, because eventually people stop panic buying, the headline fades from the front page, and the market tries to find an equilibrium again.
Actually, it's precisely the opposite.
Right, really.
Yeah, the market never finds that old equilibrium because the geopolitical friction doesn't stay abstract. It desperately needs a transmission mechanism.
A way to cross over.
Exactly, to cross over from the realm of political science into hard mathematical economic reality, and it finds that vehicle immediately.
Which brings us to the core analysis. The catalyst is geopolitics, but the transmission mechanism that physically forces the global market's hand is oil.
Yes, oil.
This is the first critical link in our loop. Oil translates a political threat into a quantifiable mathematical reality. And I really want to dig deeply into the mechanics of this
It's crucial, yeah.
because I think traditional economic modeling completely fails to capture how the energy market actually functions.
Oh, it completely misses the asymmetry.
Yes, the massive asymmetry in how oil reacts to the world. It spikes violently and rapidly on the mere fear of a supply loss.
Just the fear.
Right. But it falls incredibly slowly when demand starts to weaken.
Let's break down the actual plumbing of the oil market to understand why that asymmetry exists.
Okay.
The psychology of energy trading is deeply skewed towards supply-side panic. Oil is traded on futures markets, right?
Meaning people are buying and selling contracts for physical delivery months down the line.
Correct. So if a major pipeline is threatened, or a strait is blockaded, or a producing nation is hit with sanctions, traders do not wait to see if the barrels actually stop flowing.
They can't afford to wait.
Exactly. They extrapolate the potential loss of millions of barrels instantly. The price gaps up. A $50 barrel becomes an $80 barrel in a matter of days.
Because, think about it, if you're an airline or a logistics company, you have to hedge your fuel costs.
You have no choice.
You can't afford to wait and see if the war gets worse. You buy the contracts right now at a premium to guarantee you have fuel to run your business next quarter.
And that sheer scramble for security drives the price up immediately. But look at the other side of the equation: demand destruction.
Right. What happens when it goes the other way?
When central banks raise interest rates to cool down the economy and fight inflation, the resulting drop in oil demand is agonizingly gradual.
And not overnight.
Not at all. It takes months, sometimes quarters, for the downstream effects to materialize. It takes time for consumers to feel the pinch and, cancel their summer road trips.
Or for manufacturers to work through their backlog of orders and eventually reduce their factory output from 3 shifts a day down to 2.
Exactly. So you do not get a smooth, manageable adjustment in the energy market. You get sudden, violent upward shocks, followed by a grueling, sticky plateau.
And the sheer footprint of oil makes those violent upward shocks impossible to quarantine.
It infects everything.
Yeah, I think people often compartmentalize oil as just, well, the price I pay at the gas pump.
Which is such a narrow view.
It is the kinetic energy of modern civilization.
Yeah.
I mean, if the price of palladium or cocoa spikes, it's a localized problem for automakers or chocolatiers.
Right, but if oil spikes, it infects everything simultaneously. Trace the footprint.
Let's do it.
It is the diesel fueling the maritime cargo ships and the freight trains. It is the fuel running the tractors that plant and harvest global agriculture.
So food prices get hit.
Immediately. And it is the primary feedstock for petrochemicals.
Meaning it dictates the cost of plastics, industrial resins, fertilizers.
When the price of oil rises, the base operating cost of physical existence rises. The shock spreads ubiquitously.
Which pulls us directly into the second link in our geopolitics liquidity loop, how that oil shock mutates into sticky inflation.
Yes.
And if there's one concept you listening really need to fundamentally grasp to navigate this economy, it is the profound difference between demand-driven inflation and cost-push, or energy-driven inflation.
This distinction is where so many traditional portfolios fail, completely fail.
Let's look at the mechanics, because demand-driven inflation is the classic scenario you learned in Economics 101, right?
Yeah, it's the too much money chasing too few goods idea.
The economy is booming, unemployment is incredibly low, wages are high, credit is easy to get.
And everyone simultaneously decides they want to buy a new car, take a vacation, and remodel their kitchen.
Exactly. Businesses raise prices simply because the consumer has an abundance of cash and is willing to pay more. It's a symptom of prosperity running a bit too hot.
It's the roaring 20s scenario. But energy-driven inflation is entirely different.
It doesn't come from prosperity.
No, it comes from friction. It acts like a regressive tax on the entire system. Let's walk through the life cycle of how this inflation actually embeds itself in the economy, step by step.
Okay, it begins with that sudden geopolitical shock to the oil market.
Right, and within weeks, that translates to higher fuel costs at the wholesale level.
Okay.
Those higher fuel costs immediately impact the logistics sector. The trucking companies, the rail lines, the maritime shippers, their daily operating margins are suddenly deeply in the red.
Because they cannot absorb a 30% spike in diesel costs out of nowhere.
They can't, so they pass those costs down the chain to the distributors and the wholesalers.
And then the distributors pass it to the retailers. Suddenly, the cost of moving a pallet of food from a farm in California to a grocery store in New York has basically doubled.
And the grocery store manager isn't seeing higher demand from shoppers.
No, they're just seeing higher invoice costs from their suppliers.
Exactly. So the price of milk, eggs, and bread goes up on the shelf. The price of consumer electronics goes up. But the consumer hasn't gotten a raise.
So they're getting squeezed.
This is the crucial inflection point for the economy. Businesses face an impossible choice. They try to pass these higher input costs onto the consumer to protect their profit margins.
But because this isn't demand-driven inflation, because the consumer doesn't actually have excess cash, the consumer eventually hits a wall.
They push back. They trade down to cheaper brands, or they simply stop buying discretionary items altogether.
And when businesses realize they can no longer pass the costs on without destroying their sales volume, what happens?
They are forced to eat the costs. Their profit margins begin to compress violently.
Wow. And while the businesses are getting squeezed, the workers are looking at their grocery bills and their utility bills and realizing their standard of living is dropping rapidly.
And this is where the psychology of inflation changes everything. The workers demand higher wages.
They have to.
They unionize, they strike, or they simply quit and move to competitors offering higher base pay just to keep their heads above water.
And here is where the inflation truly metastasizes.
Yes. Once cost of living pressures bleed into wages, the inflation becomes structurally sticky.
Because a spike in oil prices can theoretically reverse if geopolitical tensions cool down.
Sure, but once a company gives its workforce a 10% raise across the board, that wage increase never reverses. It becomes a permanent increase in the baseline cost of human labor.
So it's like a virus jumping from the respiratory system into the nervous system.
That's a perfect analogy.
When it's just an energy shock, it's acute, it's painful, but it's isolated. But once it jumps into the cost of goods and finally infects the structural wage market, the whole body is infected. The entire baseline of the economy has mutated.
And this mutation triggers the third and perhaps most devastating link in our chain.
The central bank policy trap.
Exactly. Because when this sticky cost-push inflation takes hold, Central banks, like the Federal Reserve or the European Central Bank, they're forced into a corner where they have absolutely no good options.
Okay, let's really break this down. Because I hear people talking about the Fed raising rates all the time, but the mechanics of why they do it in this specific environment often feel completely counterintuitive.
It confuses a lot of people.
Historically, central banks raise interest rates when the economy is booming, right? When they need to throw water on that demand-driven inflation we just talked about.
Right.
But in our Luke, the economy isn't booming. The economy is struggling under the weight of an energy tax, and yet the central banks are hiking rates anyway.
Yeah, let's examine the primary tool a central bank has, the overnight lending rate. When they raise this rate, they are effectively raising the foundational cost of borrowing money across the entire economy.
And that cascades into everything.
Everything.
Yeah.
Mortgage rates go up, making housing unaffordable. Corporate bond yields go up, making it massively expensive for a company to build a new factory or hire new workers.
Credit card interest rates spike.
Yes. The explicit stated goal of raising interest rates is to destroy demand. It is to make money so expensive that people simply stop spending it.
Wait. If the inflation is coming from an external supply shock, like a drone strike on a Saudi oil facility, or a war disrupting grain shipments in the Black Sea, raising interest rates in Washington, D.C. or Frankfurt doesn't magically put more oil in the ground. It doesn't rebuild a bombed-out port.
No, it doesn't.
So aren't central banks basically just aggressively using the wrong tool to fight a supply problem, simply because it's the only lever they have to pull?
This raises an important question, and you have hit on the defining macroeconomic vulnerability of our era. Yes.
Wow.
They are using a demand-side hammer to attack a supply-side nail.
That sounds dangerous.
It is. When a central bank applies demand destruction to an economy that is already suffering from a supply shock, they are no longer tightening into an expansion.
Which would be a healthy, normal economic cycle.
Right. Instead, they are tightening into a slowdown. The higher energy and food costs are already acting like an anvil, dragging the economy down.
And then the central bank steps in and drops a piano on top of it by crushing the credit markets.
That's exactly what happens.
So why do they do it? I mean, if they know it's going to cause immense economic pain without actually fixing the root cause of the supply chain issues, why not just let it run?
Because they are absolutely terrified of the wage spiral we just discussed.
Oh, right.
They know they can't print oil, but their core mandate is to maintain price stability. If they allow inflation expectations to become unmoored.
If the public starts to believe prices will rise by 10% every year forever.
Exactly. If that happens, the currency loses its credibility entirely. So they are forced to maintain deeply restrictive financial conditions.
To keep rates high for much longer than the market anticipates.
Simply to break the back of the labor market and prevent that virus from fully infecting long-term inflation expectations.
And they are doing this while simultaneously engaging in quantitative tightening, or QT, which is another concept we really need to unpack here.
It's massively important.
Because QT is actively draining the lifeblood out of the financial system.
Let's explain QT mechanically. During the unipolar low inflation era, central banks engaged in quantitative easing.
QE.
Right. They bought trillions of dollars of government bonds to inject cash into the banking system, suppressing interest rates artificially to stimulate growth.
Free money, basically.
Basically. QT is the brutal unwinding of that process. The central bank lets those bonds mature and literally disappear from their balance sheet.
So they're actively destroying the money they previously created.
Yes. They are sucking liquidity out of the financial plumbing at the exact same moment. They are also hiking the cost of borrowing.
It strips away all policy flexibility. And this is where the math gets genuinely terrifying. We live in a world that has spent the last 15 to 20 years entirely addicted to zero interest rate policy.
Completely addicted.
You have governments running massive deficits. You have zombie corporations that only survive because they can constantly roll over their debt at 1% interest.
And you have heavily financialized markets that used extreme leverage to juice their returns.
So when the central bank forces the cost of capital to surge because they are fighting a geopolitical oil shock, all of those leveraged structures face a reckoning.
And that pressure forces a massive systemic repricing across the entire financial landscape.
This transitions us perfectly to the market implications.
Right, let's look at how this mechanically impacts the assets most people actually hold in their portfolios.
Take equities, for example. Stock prices face what you call severe valuation compression. Let's explain that because it sounds like jargon, but it's actually a very pure mathematical concept that drives tech stocks and growth companies into the ground during these environments.
It is pure math. The value of a stock, fundamentally, is the present value of all the cash that company will generate in the future.
Right.
To figure out what a dollar of profit 10 years from now is worth today, analysts use a discount rate, which is heavily tied to the central bank's interest rate.
Okay, so when interest rates are at zero, money is free.
Yes, and investors are willing to wait a decade for a tech startup to finally turn a profit because they literally have no alternative yield.
But when the central bank hikes rates to 5%,
The cost of waiting becomes astronomical. Suddenly, you can get a guaranteed 5% return just by holding a government bond.
therefore, that speculative dollar of profit 10 years in the future is mathematically worth much less today.
Exactly. The multiple that investors are willing to pay for the stock compresses violently, valuation compression.
So tech stocks take a beating. But the traditional safety net fails too. I mean, for decades, the golden rule of portfolio management was the 60-40 split.
60% in stocks, 40% in bonds.
Right. The logic was that if the economy slowed down, central banks would cut rates and your bonds would shoot up in value, offsetting your stock losses.
But in the geopolitics liquidity loop, the bond market utterly fails to do its job as a diversifier.
Why?
Because if the root problem causing the market panic is sticky, supply-driven inflation, the central bank cannot cut rates. They have to keep them high.
And when inflation is high and rates are rising, the fixed yield of an existing bond becomes a lot less attractive.
So bond prices collapse right alongside equity prices. There is nowhere to hide in traditional asset classes.
Wow. Which takes us into the deeper market implications of this loop. Because while the repricing of stocks and bonds gets all the headlines on financial television, the most critical systemic mutation is happening quietly beneath the surface.
In the foreign exchange or FX markets.
Yes. Let's talk about FX and the reshaping of currency markets.
The FX market is the true battleground of the global economy. It is where all the underlying macroeconomic imbalances between nations are violently expressed.
And in the tightening cycle we have been describing, driven by inflation, geopolitical friction, and surging interest rates, we see the U.S. dollar strengthen immensely.
But it is crucial to understand that it is not strengthening for the traditional reasons.
Right, because I look at the U.S. economy, and maybe manufacturing is slowing down, consumer credit card debt is at record highs, and yet the dollar is absolutely crushing other currencies.
Historically, a strong currency reflected a booming domestic economy. You wanted to invest in a country, so you bought their currency.
But today, the dollar is operating on a completely different logic.
Entirely different. The U.S. dollar in this loop strengthens primarily due to raw, desperate liquidity demand.
Explain that.
To understand this, we have to look at the plumbing of the global financial system, the euro-dollar market.
Okay.
The vast majority of global trade, cross-border loans, and international corporate debt is denominated in U.S. dollars.
Regardless of whether the transaction involves the United States at all. Let's give an example to make that real for the listener. Say a company in Brazil wants to buy solar panels from a manufacturer in China.
Right. They don't usually settle that trade in Brazilian reals or Chinese yuan.
They settle it in U.S. dollars.
Yes. The Brazilian company borrows dollars to finance the purchase. The world has created trillions of dollars of debt outside the United States.
And that is the trap.
It's a huge trap. When the U.S. Federal Reserve raises interest rates to fight domestic inflation, they are simultaneously raising the debt servicing costs for the entire planet.
So as global economic conditions deteriorate due to the geopolitical shocks we discussed, international cash flows dry up.
But that Brazilian company still owes dollars to its creditors.
So a mad scramble ensues. Entities around the world are forced to sell their local currencies and buy U.S. dollars just to service their existing debt and keep the lights on.
The demand for the dollar skyrockets, entirely disconnected from the health of the U.S. domestic economy.
It's not a vote of confidence in America.
Not at all.
It's a global margin call. It's a scramble for the world's reserve currency out of sheer necessity. And this dynamic creates a devastating asymmetry across different nations.
It brutally punishes energy importing nations. Let's use Europe or Japan as the prime examples.
Yeah.
If you are an energy importing nation, the geopolitics liquidity loop hits you with a double-edged sword. First, the geopolitical shock in the Middle East or Eastern Europe raises the underlying price of the oil and natural gas you desperately need to import.
Just to keep your factories running and your citizens warm. That's the first blow.
But the second blow comes from the currency market.
Because global commodities like oil are priced in U.S. dollars.
Exactly. As the global scramble for liquidity drives the value of the dollar up, the value of the euro or the Japanese yen collapses in relative terms.
So not only is the absolute price of the oil higher, but the currency you were using to buy the dollars to buy the oil is suddenly worth much less.
You are paying a massive premium on the exchange rate. Your national trade balance deteriorates rapidly, and you import a massive wave of inflation right into your domestic economy.
It's a brutal compounding math equation. But let me push back on the other side of the trade for a second.
Go for it.
What about the energy exporters? If I'm Saudi Arabia or Brazil or even certain sectors in Canada, shouldn't I be thrilled? The price of the commodity I sell is through the roof, and I'm getting paid in surging U.S. dollars. That sounds like a massive windfall.
Well, in isolation, it appears to be a windfall. They do benefit initially,
Right.
but this is exactly why thinking in isolated variables fails in the modern macro environment. You have to trace the loop all the way through.
Okay, let's trace it.
The exporter gets a massive influx of cash in the first few months of the shock, but remember the subsequent links in the chain. The higher oil prices cause sticky global inflation.
Which forces central banks worldwide to hike rates aggressively.
And those rate hikes crush consumer demand and slow down the global economy.
And eventually, a slowing global economy requires less energy, fewer raw materials, and less copper.
Furthermore, the immense financial tightening caused by that strong U.S. dollar suffocates global credit. Emerging markets can't borrow money to build infrastructure.
Ah.
So the initial gains the exporters made on the commodity side are eventually completely neutralized by the broader macroeconomic deterioration. The demand for their exports collapses.
This dynamic fundamentally breaks the traditional concept of safe havens in the currency market, too.
Completely breaks it.
I mean, for decades, investors were trained with a very specific playbook. In a risk-off environment, when a war breaks out, or a pandemic hits, or markets panic, capital automatically fled to certain currencies considered universally safe.
The Japanese yen and the Swiss franc were the ultimate bunkers. You bought them to protect your wealth.
But in the geopolitics liquidity loop, that historical playbook is actively dangerous.
Let's look at the mechanics of why the Japanese yen historically functioned as a safe haven and why it fails now.
Yes, explain the carry trade.
Historically, Japan had interest rates pinned at zero. Investors engaged in what we call the carry trade. They would borrow massive amounts of Japanese yen at 0% interest, sell the yen to buy U.S. dollars, and then invest those dollars in higher-yielding assets.
Like U.S. Treasury bonds yielding 4%.
Right. They pocketed the difference.
And when a global panic hit, those investors would get scared, sell their U.S. assets, buy back the Japanese yen to repay their original loans, and that sudden demand for yen would cause the currency to strengthen massively.
It was a mechanical safety valve. But look at how the geopolitical loop short-circuits that mechanism today.
How so?
If the initial panic is caused by an energy shock, Japan, which imports nearly all of its energy, sees its trade deficit explode.
Because oil is so expensive in dollar terms.
Exactly. The fundamental value of the yen deteriorates because the country is bleeding cash to pay for imported oil. The central bank in Japan is trapped.
They can't raise rates to defend the currency without crushing their heavily indebted domestic economy.
Right. So right when global investors expect the yen to act as a shield, it collapses. The historical correlations fracture completely.
And as those historical relationships fracture, the entire global financial system has to rapidly and violently adjust. Capital flows shift erratically across borders.
Those massive carry trades we just discussed are aggressively unwound.
Enforcing fire sales of assets across the globe, global funding costs spike, volatility explodes across every asset class.
And all of this mechanical stress leads us to the final and absolutely most critical stage of the entire geopolitics liquidity loop.
The evaporation of liquidity.
Yes. We need to spend significant time defining this concept because liquidity is arguably the most misused buzzword in financial media.
Oh, absolutely. People hear the word liquidity and they picture the money supply. They picture a giant vault of cash at the Federal Reserve or the M2 money supply charts.
They assume that if there is a lot of cash in consumer bank accounts, the market is liquid.
Right. They equate liquidity with the absolute volume of money.
What's fascinating here is that the definition of liquidity that actually dictates market survival has very little to do with the total supply of money sitting in accounts.
Then what is it?
True market liquidity is about depth, stability, and velocity. It is the ease with which the market functions. Mechanically, liquidity is defined by your ability to execute a massive transaction without moving the price against yourself.
Let's illustrate that. If I own 10 shares of a tech company, I can sell them instantly,
Yeah,
and the price of the stock won't budge. The market easily absorbs my tiny trades.
sure.
But if I am a massive pension fund, and I need to sell $1 billion worth of government bonds to raise cash, true liquidity is having a market robust enough to absorb that massive sell order smoothly.
Right, without the price of the bonds plummeting 10% while you're trying to execute the trade.
And the entities that provide that smooth absorption are the market makers, the major banks, and the arbitrageurs.
They step in to buy when others are selling, providing depth to the order book.
But remember the loop we've built. Interest rates have risen aggressively.
The US dollar is acting like a wrecking ball across global currency pairs.
The cost of borrowing capital for those market makers has skyrocketed. The volatility and uncertainty of the geopolitical landscape make providing that depth incredibly risky.
So the market makers pull back. They widen their spreads. They refuse to step in and catch the falling knife. The market physically thins out.
And this brings us back to the stadium analogy from the very beginning of our deep dive. Let's look at that stadium again through the lens of everything we've just discussed.
It's the perfect way to visualize it.
A normal, highly liquid market is a massive stadium with tens of thousands of people moving around freely. All the exit doors are wide open.
If there's a minor incident in one section, people just casually walk out through the nearest door. The system easily absorbs the flow.
But the geopolitics liquidity loop changes the architecture of the building. The central bank's hiking rates and draining cash through QT.
That's management locking half the exits.
The surging US dollar squeezing global credit.
That's management chaining the remaining doors shut, leaving only one narrow turnstile open at the far end of the concourse.
Now, in that illiquid, physically constrained environment, someone yells fire. The geopolitical shock hits.
A pipeline is attacked, or a major tariff is announced.
And the panic that ripples through the crowd is no longer proportionate to the size of the fire.
The panic is driven entirely by the realization that there are no exits. The structure of the room itself is what makes the situation lethal.
Because in a deep, liquid market, large capital flows can be absorbed smoothly. The shock happens, money moves from one asset class to another, and prices adjust efficiently.
But in a thin, illiquid market, our stadium with one exit, even tiny marginal capital flows cause massive, outsized price moves.
The price action becomes discontinuous. It gaps up and down violently because there is no one on the other side of the trade to smooth it out.
This is exactly when you see the phenomenon of correlations breaking down.
You look at your trading screens, and assets that have historically moved in lockstep for 20 years are suddenly diverging wildly.
Assets that are supposed to act as hedges against each other are crashing at the exact same time.
And why does that happen mechanically? It's not like the underlying economic reality connecting those assets disappeared overnight.
No, the economic logic is still there, but the liquidity required to maintain the relationship is gone. Historically, when two correlated assets diverged, hedge funds would step in. They would buy the undervalued asset and short the overvalued one, pocketing the arbitrage and forcing the prices back into alignment.
But in our locked stadium, those hedge funds can't get the cheap credit necessary to put on those trades.
The cost of capital is too high and the volatility is too terrifying, so the arbitrage mechanism breaks.
And when the arbitrage breaks, forced deleveraging triggers. This is the death spiral of an illiquid market.
It is. Funds that used borrowed money to enhance their returns are suddenly hit with margin calls by their prime brokers.
The broker looks at the plunging, erratic asset prices and demands more cash collateral immediately.
But the fund doesn't have cash, so what do?
They have to sell assets to raise the cash.
But they can't sell the toxic, illiquid assets that are causing the problem because there are no buyers.
So they are forced to sell their good assets. They sell their high-quality stocks, their gold, their treasury bonds.
They sell whatever they can, regardless of fundamental value, simply to meet the margin call.
And this forced selling drives the prices of those good assets down.
Which triggers margin calls for other funds, creating a cascading wave of liquidation. The market shifts entirely from trading on economic fundamentals to trading purely on positioning and emergency liquidity needs.
And this brings us to the completion of the loop. Because this tight, illiquid, highly fragile market doesn't exist in a vacuum. It sits right back underneath the geopolitical landscape where our story began.
The loop feeds back into itself. It serves as an engine of instability. Tighter global liquidity actively amplifies the impact of the next geopolitical shock.
Because the market has lost its depth and its shock absorbers.
Right, so a new escalation in the Middle East or a new tech embargo causes an even more violent spike in oil than it would have a year prior.
That more violent spike in oil causes inflation expectations to unmoor even faster.
That forces the already trapped central banks to panic even more, keeping policy tighter for longer.
Which further strangles the remaining liquidity. The structure of the market itself becomes the primary amplifier of the trauma.
It's a terrifying mechanical reality. It's not just that bad things are happening in the world, it's that the financial system's ability to absorb bad news has been fundamentally crippled.
Every minor bump in the road threatens to break an axle.
Precisely.
Which leads us to the most critical part of this analysis, the actionable takeaways. Here's where it gets really interesting for you, the listener. If you're managing a portfolio or advising a corporation or trying to protect your own savings, how do you actually survive an environment where cause and effect are blurring together into this vicious feedback loop?
Well, first off, the traditional models are clearly dead. They are completely obsolete.
So we have to trade the loop, not the trend.
Exactly. If you are relying on risk models built on the stable, unipolar correlations of the 2010s, you are flying blind into a hurricane. You cannot rely on lagging indicators anymore.
Like looking at year-over-year GDP prints or trailing 12-month corporate earnings ratios.
Essentially useless. By the time that data is published, the reflexive system has already moved on and altered the underlying reality. You have to trade the loop.
So let's give actionable advice for navigating this. Actionable advice 1. Watch oil as the ultimate leading indicator. You have to fundamentally change how you analyze the energy market.
You can no longer look at oil merely as a sector play or a proxy for summer driving demand or a debate over the transition to renewable energy.
You must view oil as the ultimate real-time leading indicator. It is the canary in the coal mine for the entire macroeconomic environment.
When you see oil breaking out and the futures curve backwardating due to geopolitical friction, you are not just looking at a higher price at the pump.
You are looking at a real-time preview of future sticky inflation.
You are looking at a preview of future central bank panic and future liquidity withdrawal. You must monitor the asymmetric price action of oil as the absolute trigger for managing risk across the rest of your portfolio.
When oil surges in a multipolar environment, you de-risk immediately.
Absolutely.
Okay, actionable advice number 2. View central banks through the lens of constraint, not intention. Change how you listen to them.
Financial media spends thousands of hours obsessing over what the Federal Reserve or the European Central Bank wants to do.
Analysts parse every speech, looking for hints of optimism, hoping the Fed is going to ride to the rescue and cut rates to save the stock market.
You must discard the concept of central bank intention. You have to view them entirely through the lens of constraint.
It does not matter what their long-term economic forecasts say.
And it does not matter if they privately want to ease financial conditions. Look purely at what the geopolitical loop is forcing them to do.
If oil is structurally elevated and you see the logistics sector passing costs into wages, the central bank is trapped.
They cannot cut rates without reigniting the inflation fire and destroying their currency's credibility. Assume their hands are tied.
Position your business and your portfolio for structurally higher capital costs and eliminate any reliance on cheap debt refinancing.
Yes.
And actionable advice number 3. Treat the U.S. dollar as a proxy for global liquidity conditions. Redefine the dollar on your dashboard.
Stop looking at the dollar index simply as a reflection of how well the U.S. economy is performing relative to Europe or Asia.
When the dollar is surging, it is a warning siren that global liquidity is evaporating.
It means the eurodollar system is under stress, global funding costs are spiking, and the stadium doors are being chained shut.
The true edge for any strategist or investor today comes from understanding these second-order consequences. Everyone sees the headline about a drone strike or a tariff.
Everyone sees the initial 5-minute reaction in the stock market.
But geopolitics only starts the process. It is the subsequent liquidity crunch that determines how far the economic damage actually goes.
Understanding the mechanics of that distinction is exactly what separates those who merely react in a panic to volatility from those who can successfully navigate it and protect their capital.
So what does this all mean? Let's pull all of this together and trace the dominoes one last time, so the architecture of this crisis is perfectly clear.
It's quite the chain.
It starts when the constant friction of our new multipolar world sparks a geopolitical fire. Oil acts as the physical transmission wire, carrying that shock out of the political realm across borders and deep into the logistics and supply chains of the global economy.
And then that energy shock mutates from a temporary price spike into sticky, entrenched wage inflation.
That inflation backs the central banks into a desperate corner, forcing them to hike interest rates and drain cash using QT right as the economy is already slowing down.
Those surging rates act like a wrecking ball on the foreign exchange markets, causing the U.S. dollar to squeeze the globe for funding and crushing energy importing nations.
And finally, all of this chokes off global liquidity,
Whoa.
locking the exits in the stadium, causing correlations to break and margin calls to trigger. It leaves the entire financial system incredibly fragile, illiquid, and hypersensitive to the next inevitable geopolitical spark.
The loop completes and prepares to amplify the next crisis.
It really is a sobering reality.
It is. And if we accept the terrifying mechanics of that reality, I want to leave you with a purely macro strategist thought to mull over.
Let's hear it.
We have established today that global market liquidity, the depth, the market makers, the functioning arbitrage is the ultimate shock absorber for the world economy.
Right.
And we have established through the mechanics of this loop that right now that shock absorber is thinning out to historic lows. At the exact same time, multipolar geopolitical friction is rising to historic highs.
Two massive forces colliding.
So the vital question you have to ask yourself as you look at the horizon is this: what happens to the global financial architecture when a massive, truly unforeseen geopolitical event strikes a market that literally has zero absorption capacity left?
That is the defining question for the next decade of global markets. It gives you chills. Thank you for joining us on this journey deep into the macro machinery today. We'll see you next time on The Deep Dive.